IRS announces new waiver procedure for taxpayers who inadvertently missed the 60-day rollover deadline. If you're eligible to receive a taxable distribution from an employer-sponsored retirement plan, like 401k, you can avoid current taxation by directly rolling the distribution over to another employer plan or IRA. With a direct rollover, you never actually receive the funds. You can also avoid current taxation by actually receiving the distribution from the plan and then rolling it over to another employer plan or IRA within 60 days following receipt. But if you choose to receive the funds, instead of making a direct rollover, the plan must withhold 20% of the taxable portion of your distribution, even if you intend to make a 60-day rollover. You'll need to make up those withheld funds from your other assets if you want to roll over the entire amount of your planned distribution. Similarly, if you're eligible to receive a taxable distribution from an IRA, you can avoid current taxation by either transferring the funds directly to another IRA or to an employer plan that accepts rollovers, or by taking the distribution and making a 60-day indirect rollover. Under recently revised IRS rules, you can make only one tax-free 60-day rollover from any IRA you own, traditional or Roth, to any other IRA you own in any 12-month period. However, this limit does not apply to direct rollovers or trustee-to-trustee transfers. Because of the 20% withholding rule, the one rollover per year rule, and the possibility of missing a 60-day deadline in almost all cases, you're better off making a direct rollover or trustee-to-trustee transfer to move your retirement plan funds from one account to another. Exceptions to the 60-day rollover deadline. But what happens if you do receive an actual distribution from your employer plan or IRA and you want to roll over the funds, but you've missed the 60-day deadline? There are limited statutory exceptions to the 60-day rule. For example, the time for making a rollover may be extended for those serving in a combat zone or an event of a presidentially declared disaster or terrorist or military action. But the IRS also has the authority to waive the 60-day limit where the failure to waive such requirement would be against equity or good conscience, including casualty, disaster, or other events beyond the individual's reasonable control. To seek a waiver, you previously had to request a private letter ruling from the IRS. However, the IRS has just announced a simpler alternative to seeking a private letter ruling. The new waiver alternative, which is known as self-certification. Under the new procedure, if you want to make a rollover but the 60-day limit has expired, you can simply send a letter to the plan administrator or IRA trustee custodian certifying that you missed the 60-day deadline due to one of the following 11 reasons. Number 1, the financial institution receiving the contribution or making a distribution to which the contribution relates made an error. Number 2, you misplaced and never cashed a distribution made in the form of a check. Number 3, your distribution was deposited into and remained in an account that you mistakenly thought was an eligible retirement plan. Michael Guttadaro from the Connecticut Institute of Finance.